Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, the markets, the economic turbulence, everything has been a little crazy yet. And yet investors have a way to make some money still.
Yeah, I mean, look, there's always going to be a hunt for something outperforming. And obviously the last decade, it's been like growth stocks and tech stocks and anything that was shiny was really where it was at. Now we've got a whole new environment. And now what's interesting is one of those areas that is seeing inflows way beyond what they normally see and beyond their weight in assets. So they're punching above their weight is high-dividend ETFs. And any analyst will tell you they get asked about income all the time. Like that's like an evergreen topic. So you have the need for yield, yet people are skittish to get that yield in the bond market right now because they know the Fed is hell-bent on raising rates. So they want yield still. And normally, high-dividend ETFs are not that great because they tend to hold energy and utilities because that's where high dividends are. But this year, those sectors rule. So you've got this perfect 1-2 punch in these ETFs. I call it the sweet spot where they've got two things that people want, which is that energy exposure and the high dividends. And so they have taken in about $25 billion this year. That's already a record. And I think they might take in 50, and they are not that big of a category. So this is a nice little feeding frenzy, and we should really dive into this. I think it's a classic, how to play episode.
Okay, so joining us will be Todd Rosenbluth. He's a regular on Trillions, and he's got a new job. He's the head of research at VettaFi, as well as Suzanne Woolley, personal finance reporter with Bloomberg Wealth. This time on Trillions, high-dividend ETFs. Todd, Suzanne, welcome back to Trillions.
Good to be here.
Good to be with you all.
Okay, so Eric set the table there. Things have turned really quickly, and all of a sudden, a category that probably a lot of people weren't paying attention to is something that people should be interested in. Todd, what kind of returns are we looking at in general in this category?
So I guess to set the stage, we've got the S&P 500 at the time we're recording this down 23%. The high dividend yields tend to have fallen less than half of that, 10%. And in some cases, they're close to treading water for the year. So you would have saved 2,000 basis points, perhaps, depending upon whether or not you were in some of these dividend yielding ETFs. And maybe if I can pare back for a second, and maybe you guys were going to do this, but there's two main types of dividend ETFs. There's dividend growth ETFs, where the companies have a long record of paying and growing their dividends, but the yields are close to the broader S&P 500. And then you've got these high dividend yielding ETFs that we're going to talk about, where the yield is 3, 4, sometimes even 5%. And the companies that are constructed are based on the yield, not based on their record of paying dividends. And so I think that's an important distinction. It's not all dividend ETFs are the same as I now say at VettaFi. Okay, so by the way, congrats on that new gig. Before we go to Suzanne, I want to just ask you and Eric always have these bets going concurrently. What bets are live right now? So there's no dividend bet. I will say that the last
there might be by the end of the episode, though.
There might be. The last time that I was on here, Eric sprung a bet on me that I said yes to on the fly, and I stick with that. So I'll highlight that one because that's the one I think he's more confident in than the other, and he can perhaps highlight the one that he thinks I should be more confident in. So last time we bet that Capital Group, which was at the time soon to launch actively managed equity ETFs. They subsequently did that in February, I believe in late February, that they would have assets under management of $7 billion or more by the end of that first 12-month period. That is a live bet. They have been growing assets. It's close to $2 billion. I realize that if he'll do the math here for you and add that up, and it will be under $7 billion, but we're going to see an accelerated growth. So I'm still feeling very good about that one. But that one I could see coming closer to the wire than the next one that I'll let Eric set up because I feel confident in ESG.
Yeah, so the Capital Group one I'm pretty confident on, although they are a massive company and they know about this bet, and they can just move a couple billion if they wanted to. Like on the night before, they could just make Todd win. So they always have that lever they can pull, and that makes me nervous. But otherwise,
that sounds like a Boomerati conspiracy theory there, I think.
Yeah, I mean, and plus the market's going down, so that hurts assets. So I like my chances based on trajectories, but they always have that lever. But the other bet we have is I bet that 25% of ESG ETFs would liquidate by the end of this year. This is back when they had 79 or something. So I need about 20 or 19 to liquidate by the end of the year. And so far, I think only 2 or 3 have. But it's trending up. And if the market keeps getting awful and the ESG baggage keeps increasing, which it is, 6 months, I think I've got a shot. I think I'm like a 15-1 shot to win that one, but I'm total favorite to win the Capital Group one.
And in my recollection is that Eric has the upper hand in this betting history, correct?
Yes. We've had a couple close ones, and then
Todd was silent and grimacing. Okay, Suzanne, let's bring you back in. I want to talk to you about when you talk to investors or advisors. How do people feel about this category in general?
High dividend, I think people right now feel like pretty good about it because they're looking for anything that has like the whiff of certainty. Having been in, people have found themselves so overweighted in tech, not even realizing it, in the S&P. Everyone is desperate for income. So, the big thing I hear about every advisor is talking about, of course, is like Series I savings bonds, which track inflation, because they're at like 9.6%. But you can only buy 10,000 of them a year. So it's not going to do a lot for your portfolio. So, energy's been hot, like you said before, energy and utilities, So this is an area that, like Eric said, a lot of money is going into and a lot of people are talking about.
I want to jump on in quickly, if I can, to say I wasn't grimacing. I was being polite and waiting for Suzanne to be brought into the conversation because that's the appropriate thing to do. But I think to piggyback on what Suzanne was saying, there's been just a search for income. We've done surveys with advisors at VettaFi, and they're continually looking for alternatives to fixed income. So I know you've talked about covered call, series of products beforehand on this platform. We've talked about, inflation protection you have on this platform. The high dividend yielding products have been around a while. iShares and Vanguard have had products that have 10, 15 year plus histories, but they come up when investors are seeking out that income component, and we've got now even more products than ever before to give investors and advisors choices.
One of the key things here, though, is that the U.S. 10-year Treasury yield is now up to 3.2%. That's pretty good, but these high dividend ETFs are going to yield. Some of them yield a little more than that, some a little less. But I think it's interesting just to note that I do believe investors just they're just more scared of the bond market right now because that's where the Fed has a direct impact. Whereas because bonds, all the rates are going up, all the new bonds, you can get a higher rate. It really questions the value of the current bonds. Over on the equity side, the other thing about this is, yes, you get the yield it's around 3 to 3.2% for most, but that's double the S&P's yield. And you get that pop because it's largely in energy and utilities. And so I think that's also important is because the return is a yield in a way too, by not underperforming. So it's the right yield. It's not just a yield. It's a better yield, I think, for many investors. Until the Fed cools off, I just think the bond market's going to be a tough place. We've seen it in the flows in mutual funds in particular. A lot of older investors are bailing. So that's going to be a constant drain on the prices of bonds for the foreseeable future. So it's interesting how this works. Sometimes an ETF category just trods along for a decade, like, oh yeah, whatever, and then bam, the stars just align, and it's got what everyone wants.
So Todd, as these stars sort of align, let's walk through some of the tickers that jump out to you. What's your number one? Because there's 10 or 12 in this category that have sort of attracted attention? What's your number one?
Yeah, well, my number one or the number one. So the most popular
let's
one.
Let's do the number one, and then you can do your number one.
Sure. So the most popular of these ETFs this year, based on my data, I'm sure Eric's data will agree with this, is Sdiv. This is the iShares Core High-Dividend ETF. It's pulled in, as we're recording this, $5.5 billion. It's down just 1.5%. It's extremely cheap. It's focused on those sectors that Eric was talking about, not only, but it has above average exposure to high dividend yielding stocks within energy and utilities. I want to call out, I guess, two other ones that are one that is popular and one that I find to be under the radar, and I'm not sure why it's not as popular. So SPHD, which is an Invesco S&P 500 high dividend, low volatility ETF. I think I got that name right in where the dividend and the low volatility is on this. This is, as the name suggests, it not only owns, well, it starts with the S&P 500. That's important. And then it looks at companies that have both a low risk profile, less volatility, as well as an above average dividend yield. It's pulled in about $1 billion this year. It's down 4.5%. So doing still much better than the S&P 500. And then there's an ALPS sector Dividend Dog ETF. The ticker is SDOG. I think Suzanne has a dog that's staying with her. I've got a dog sleeping not that far from me. That ticker SDOG is just fun to say out loud. But what's compelling to me about this is that it's equally weighted at the highest dividend yielding stocks across all of the sectors. So it isn't dominated by energy and utilities. It has some technology exposure, less than the broader market, some financials exposure, I think less than the broader market, but it's equally spread out there. And I'm a little surprised it hasn't pulled in that much money. I think it's just under 100 million in net inflows this year, but it's performing well and it's well constructed. So I guess those are three of them that jump out to me. I'm confident my fellow ETF analyst nerd is going to have three different ones.
How do you feel about the Reits? It has a big slug of Reits, doesn't it? Real estate investment trusts.
Yeah, I mean, real estate is, important sector to have exposure to. It tends to historically do okay during a rising interest rate environment. And real estate's different than it was years ago, especially we've got these former communication services companies, American Tower, Crown Castle, that are above average dividend yielders. So I like that it's got exposure to real estate. That's a important thing to be aware of, though. Some of these don't have exposure to real estate. They intentionally carve out real estate as one of the sectors. Some don't. So it's important to take a look at and do some homework on these ETFs.
Yeah, I mean, I think if the yield is really high or the returns are just abnormally good, it's probably concentrated in something. Like it probably has more energy or more REITs. I mean, I think that's something you have to weigh. And, this is why Todd and I have job security, because even amongst high dividend ETFs, which they're all have sound the same, there are a lot of differences. And I actually went through when I wrote my note 2 weeks ago and just looked at the prospectus for how they're designed. And I guess you could say they're all similar, but they start with a different universe. Like the iShares HDV, the iShares one starts with the Morningstar US Market Index, and then it picks the 80 stocks with the strongest financial health and dividends. So there's a fundamental aspect to that one. And then it weights it by dividend. So then the SPYD, which is the S&P 500, is the universe. It takes the 80 highest. Then it kind of equal weights it more or less. But both of those, and there's the fee. Both of those are 10 basis points fee, which is really good. That's another thing about this area. It's very cheap. Like compared to like buying a dividend manager ETF back in the day, this is like dirt cheap. It's really a great service, I think, to have this kind of access for these costs. But there are differences here. And then like the Vanguard one, which is very popular, VYM, that uses the FTSE universe and it picks 500 companies. So obviously that's not going to pop as much. So I love the field number of holdings. That's an underrated field for ETFs, in my opinion, because I think most people in sniff test wise can understand like, oh, it holds 300 stocks. Okay. Versus like 50 or 80, that can tell you how you should use it. So I would say for the ones that hold 80, you really should consider that like a satellite position. Whereas you could almost move in a VYM a little more into your core. I mean, depending on what your goals are. And then there's I guess there's a slew of other ones. Everybody has one. Wisdom Tree has one. First Trust has one.
When you guys break the numbers down for this category, I mean, we've talked about energy and utilities. Is there a given company or stock that ends up basically everywhere at a high percentage? Is it like Exxon shows up everywhere in this category?
So I guess it depends. It depends upon the criteria of it. So if you're looking at high dividend, if the focus is above average dividend yield, I would think companies like ExxonMobil and Johnson & Johnson, those are higher dividend yielding stocks. Verizon, perhaps, if communication services is part of it, that tends to happen. But I want to just, if I can for a second, go back to what Eric said. The number of holdings is important, but the other thing that he said that I'll agree with is how concentrated are those holdings and whether there's equally weighted aspect to it or not. So HDV, that iShares Core High Dividend ETF, has 75 stocks. That's actually about what you'd find within the SDOG one I keep referencing. But ExxonMobil is 9% of HDV. It's going to perform better when energy does better, and when Exxon in particular does better because of that concentration. It's going to struggle that same way if a company or two that's heavily weighted underperforms.
So I just looked up Exxon, and then I searched for high dividend. It's in most of them. So first point here is, if you're an ESG type, do not invest in high dividend ETFs, which brings me up to the problem with ESG and being moral when you invest is, at some point, the money's going to win. You're going to go, I need the yield. I like the return. Screw it. That's one point. The second point is, if you look at Exxon, and you look at something like HDV, Exxon is an 8.7% weighting in that one. But then in VYM, I'm looking here, Exxon is a much more tame 2.6% weighting. And that's going to happen throughout these ETFs. Some stocks are going to have a much higher weighting. I think you tend to find like the Vanguardian ones are going to be like more market cap weighted. So Exxon couldn't possibly be 8%. But then everybody else, Wisdom Tree, even iShares, you're going to find some weight equally or by the factor itself. And if it weights by the factor itself, like dividends, you clearly are going to have some stocks that dominate the fund. And that can be a little scary because, yes, this thing yields a lot, but now it's really controlling your fund. So I think it's really interesting. And I think some investors probably would opt for the equal weighted version on these. These are probably the greatest example on like the due diligence checklist for an ETF, because there's several ways these could go. And then obviously this weighting and the expense ratio and all this just kind of adds up to a different return stream. Although I got to say, if I look at them, they're all doing pretty good relative to the S&P. There's no real crazy outliers that it's like, well, what's this doing? It's not labeled correctly. I mean, you really do get high dividends with most of these, but their approaches are pretty different.
Suzanne, I want to bring you back in. We didn't get to hear some of your favorite tickers yet in the space. Which ones have we not talked about that are on your list?
I mean, I was looking at HDV, like we talked about, the iShares one. What was interesting to me that I sort of wanted to ask you guys about was that, so much of it, the biggest holdings in that fund are in the top 20% of the S&P 500, the top 20 stocks in the S&P 500. So it just made me sort of laugh in a way because, what we've seen is our portfolios dominated by the top 10%, the top 10 stocks in the S&P. And now we're going to move into these high dividend yield ETFs and get into number 10 to number 20 in the S&P 500. But I don't know, HDV, VYM, I was looking at what I was curious that I wanted to run by you guys was, what international dividend ETFs should we be looking at? And do any of them have a big chunk, a big mix of U.S. and international dividend ETFs, dividend stocks?
Yeah, I mean, most of these are going to have some international version. I mean, these companies, it's like any sort of product, you've got Coke, Diet Coke, Cherry Coke. It's just like high dividend international, high dividend global. So like, for example, VYM has VYMI, which is the international high dividend, which is very similar. So yeah, they're going to do that. And I'm just curious, let's look at the yield difference between the two. So if VYM gives you a yield of 2.8%, which is low, but again, Vanguard, when they do factors, they really water them down by market cap weighting. Anyway, the international one yields double that, 4.7%. So, you're probably going to get a lot more yield over there, but then you're in international stocks, which have, can have issues. A lot of people like to stick in the US. I don't know if Todd, do you have a take on, like, if your mom came to you and wanted high dividends, would you send her to US or international?
Well, I think you should. I think if you're going to have international equity as a carve out of your portfolio, then it certainly can make sense to have something like VYMI, which is that Vanguard high dividend yield international ETF. As an example, I don't know that I would be seeking just income for that. I would be using that as my international slug of the portfolio. But Suzanne, your question prompted me to just go into, to quickly search for it, because I actually had forgotten this ETF existed, and maybe there's others, but there's a Spider S&P Global Dividend ETF, WDIV, which is actually much more internationally focused than your typical all country world or global approach to it. So it only has about 20% in the United States, and then Canada, Japan, Hong Kong, Switzerland, UK rounded out. And so I think that that's being constructed in part based on the yield. This is the challenge when you try to do this on the fly, is to the rules of an index. But I think that is being constructed based on the yield, and that's why perhaps, and that it has to have a criteria of having raised the dividend for a period of time. But this is just an example of, you can get a global equity dividend yielding portfolio in the mix.
And just real quick, I found a good one here. Fidelity's International High Dividend ETF. So if Vanguard's a conservative take on that, but the Fidelity kind of goes all the way. So if this thing yields a very healthy 5.3%, which looks very attractive, relatively speaking. And the holdings are pretty mixed. You got 115 holdings, and they're in a lot of different sectors. It's not just like energy, it's banks, insurance, telecom, some mining, chemicals. Again, very not ESG. And it's spread out between countries: Canada, Japan, UK, France. And interesting, the PE on this is 9.7. I mean, that is low. So you're kind of getting a value trade here too. I wonder if this thing's outperforming this year. Let me see. So this is the year-to-date returns for this. It's down 7%. So that's the thing. Like, even though you have all that good value and energy exposure, you're still down, although you're down less. Whereas the ones in the US, some of them are all close to actually, being flat.
I would add, though, Suzanne, and again, I love it when somebody brings in a question for the rest of us and keeps us on our toes. When you're investing internationally, looking at currency is important. So again, doing some quick due diligence here, DBAW, which is an X-Tracker, all country world ex-US hedged equity ETF. So it's going to hedge out that currency risk. The impact of the dollar is weighed significantly on international slices of a portfolio. So hedging that out has been rewarding in general. I presume has been the case for DBAW. So just again, lots of tools in the toolbox for an advisor to sort through and do some homework on, and just a little digging that we're doing here on the fly.
Okay, I thought of a bet that I'm going to throw out there for Todd and Eric, which is, if this has already been a record year for the high dividend ETF category, how big is it going to be by the end of the year? Overall assets under management in the space, what's it going to be?
How about we do 2022 flows? So here's the numbers, Todd. So they've taken in $25 billion this year. Now, last year they took in about $19 billion, which was their old record. So they've already beat their old record. So I would put the over under at 50, which would be double, maybe 45. I don't know.
Are you going to take the over or the under?
I'm taking the over. I'm not letting him think about it. I'm taking the over on this.
Yeah, I got to say
the over on this. You can want to set it higher. You can set it higher. I'll take the 51.
I sometimes feel like betting against Todd's excitement is a winning trade, but in this case, I just these things are so perfect for this year that I cannot take the under because I just don't feel it as much as the other one. So I gotta stand down.
You want to go to 55?
I'll take under 100.
No, well, so
Todd, come on, Todd.
That's crazy.
Suzanne, where should we put the number?
I don't know. I'm going with. I think 50 sounds reasonable to me.
I'm gonna inch it up. We're gonna say 55. Eric, are you over or under that?
The big problem with that bet, the under bet to me would be that maybe the recessionary numbers, like there's some economic signals that say the Fed has like messed up the actual economy, and they back up. All of a sudden, all the stocks in these funds are going down.
Yeah, well, that's why you can pick the under if you want.
But I don't think the Fed's going to do that because I think that because inflation is the number one issue amongst voters and the midterms are all the way in November, they're going to be hell-bent no matter what the economy says. So it's almost like betting, will the Fed back up after the midterms and before the end of the year? It's a very specific bet on that, in my opinion. And I just don't know if I feel like I want to bet on that. Because I'm just not. I don't have a clear vision, Joel.
Okay, I got Todd. Todd on the over.
Yeah, I got the over on it. See what happens, Joel? When he throws the bet at me, I go, yeah, I'll do it. When you throw the bet, he's like, I'm thinking about it, and he threw in my opinion, so he's covered himself from a compliance perspective.
Because most of the time, the bets between Todd and I happen organically on Twitter, where he'll have a take, and I'll say I don't, and then he'll be like, no, and then I'm like, all right. Like throwing my wallet on the table. Let's see if you really feel this way.
All right. Well, you guys can, after the episode wraps and everybody's out there, we'll see if we can come up with something.
No, we've got the bet. No, the bet is 50. The bet is the over on it. And if you want to slide the number up a little bit. That's the bet. I'll bet you coffee.
We'll take this to the Twitter and we'll see what the Twitter has to say.
You got a show to run, I know.
I was just wondering if there's anything interesting to note about sort of average market cap. Seemed like the Vanguard one was average weighted market cap was like 117 billion, but there are some that are much larger. I mean, smaller. HDV, larger and smaller.
Yeah, I think that's important, is to take, we're going through a number of things that are worth looking at, that are easy, do your homework checklist things of understanding how many stocks it has, understanding the sector exposure that it has or is allowed to have, the concentration, and then I think looking at the average market cap can tell you that. So these dominant, something that's got over $100 billion as an average market cap or even higher shows you that they're focusing on more of these mega cap companies. Those might be more stable, in terms of a quality perspective, but also have some less growth potential. Yeah, there's one ETF that we didn't touch on that caught my eye, which is from Global X. The ticker is DIV. It has super dividend in the name because it's the highest yielding stocks that they can possibly find around. And the market cap on that is $31 billion. And it has a number of companies in its top 10 holdings that I have heard of, like IBM and Kellogg, and a number of companies that I haven't heard of, which just tells you that it's fishing in a much broader pond than just the S&P 500.
Yeah, I mean, by the way, we should highlight that one. We've really covered the more mainstream ones, but there are a couple wild and crazy ones. Sdiv is an interesting one. It's been around a long time. It holds the 100 highest yielding companies in the world, point blank. So when you have that as your mandate, you're gonna buy some really wacky stuff, but it yields 13%. That's a crazy yield for stocks. But you're gonna own stuff like, you probably own MLPs in here. You probably own Reits. Your allocations are going to take you to China, Brazil, Hong Kong, a lot of EM. It's risky, but if I call this thing a yield-seeking missile. Again, if it's a satellite position and you want just a little bump of yield, you would obviously need to allocate less, but this thing can be volatile. Dude, the average PE on this is 5. Holy moly. That's like Nigeria. I mean, there's nothing 5. By the way, the last time I saw a PE of 5 was when we covered the airline ETF before the pandemic. I was like, these stocks are so beaten down. That had a nice run. But I will say, Nigeria has been at 5 for like 15 years. I used to look at ETFs by low PE, thinking like they were deals. Believe me, they can be deals for a long time. Like some of these country ETFs especially. But 5 is really low. That means you're buying some crap, because it means that active managers hate these stocks, but they yield a lot. That's what you get here. But
I think you mispronounced value. I think you called it something else. Just to clarify, and this is a good ETF too, SDIV. The one I was referencing was just DIV, which is the U.S. version of this, but from Global X. 2 very worthwhile ETFs that are under the radar for investors and advisors to take a closer look at.
Todd, you haven't been on the show in your new capacity before. Gotta ask, do you have a new favorite ETF ticker?
Okay, so I'm going to take the liberty, since I'm part of a company that has index capabilities, I'm going to both name something that is cool and interesting that we're tied to, and in full disclosure, we are tied to it. But there is a Procure ETF that just came out under the ticker FEMA, FEMA, which is a disaster recovery effort, and I just think that well, first of all, no one should ever have to say FEMA out loud historically, but now it rolls off the tongue to me, and it's just a cool sounding, cool name for it. So my prior submission, I used to like PBJ. That's an Invesco ETF that's food related. I think I continue to like that.
Yeah, we're kind of in disaster mode, though. PBJ sounds great, when you're in a bull market, but now that we're in a bear market, I think FEMA is appropriate. Suzanne, we haven't asked you for a while. Any new favorite ETF tickers?
No, I still love COWS, COWZ, which I think is timely because it's a cash flow ETF. But there's one I wish was in there, like OUCH, OUCH. It's actually the ticker for a company called Occupational Urgent Care Health, which I don't know what that is, but I love that ticker.
Good for the times as well.
But by the way, can I just comment on COWS? This is a very relevant issue. This is the Pacer US Cash Cows 100 ETF. This thing is like in the top 20 of most inflow ETFs. Pacer has never had a hit like this, and it tracks the free cash flow, which is very valued in this kind of market. But again, where do you get? You get a lot of energy. Basically, anything that has energy in it, even if its name is high dividend or cash flow, is really doing well this year. Simply because energy is the only thing up. And anyway, but I like cows as well. I think that's a good one. And by the way, it has a sister or a young sibling version, CAF, which is small cap free cash flow.
See, it's adorable. I love it. I know even more
that's
now.
Even better. Yeah.
Wow.
And it fits in well with this theme because the free cash flow leads to dividends, and so cows and calf are other ways to get above average dividend yields in this environment. So good call, Suzanne.
Wow, wrapping it up, Todd. Nice.
All right, Todd, Suzanne, thank you for joining us on Trillions.
You're welcome.
Thank you.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, and wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Francesca Levy is the head of Bloomberg Podcasts. Bye.